The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday in market days, and thanks to our host for a couple of great hours. And let's see if we can have another one here. First of all, a little mea culpa. Yesterday, I was showing the charts. I did make a big deal about the monthly charts, that what I call the Chapman Wave Roman candle. I'll talk a little bit more about it in a moment, but I just wanted to say that the daily chart, I thought I'd mention that if it closed ugly, that would impact the monthly chart. And if it closed well, that would be a positive in the short term. So, of course, we've had this huge sell-off this morning. Dow's down 319, was much worse earlier on. It's at 16,209. S&P's down 36 at 1935. The comp index is down 70 at 4705. You've got bonds attempting a rally. They were up quite a bit more earlier, but now they're up 7 at 1140. Silver's up 0.004 at 1459. Platinum's down. High-grade copper's down sharply. Crude oil is down sharply. Bonds are down just 9/30 seconds at 154.5. This is going to be very important. The dollar at this particular point is coming back a tad. It's down 20 cents at 95.64, trying to hold 9-period exponential moving average support. And the euro is up a little bit. Now, what I wanted to do is this. Just wanted to quickly show a couple of little things, because this is also for those of you who are trading short term. These shows, look at the 120-minute, sorry, this is the 2-minute chart of the YMU 15. That's the September Dow futures contract. Made a beautiful low this morning at about the 1650s. Ran all the way up to the 16240 level in a peak D. Pulls back. Remember the Chapman wave? We look for 4 higher peaks. It can go higher, but 4 is what you really want in a buy signal set to go to a buy mode. And then it pulls back very sharply, more than 50%, starts another rally, A, B, C, goes to a D, pulls back, and now it's making a second cup formation with a higher low bar. Is this the one that takes you above 16,000 to, it'll have to be around about 16,000, well, earlier in the day, of course, it came down sharply. So would it go above 16,247 to say that it's starting to make higher lows and higher highs? Why? I'll explain why in a moment. Let me just show you that the E-mini S&P this September has gone to an E and pulled back, gone to a second E below the previous one, just like the Dow did, futures. And now this is going to be very important. Why? Because if there's a failure here and you take out the most recent low, in this case, the futures, 16.131, that's just going to be a really negative thing. And if you're looking at the E-minis, if it takes out 1925 round number low, that was made at 1050, what was that? 1058, that'll be quite negative. At this particular point, now I want to go to the whole story. What we're looking at here is in the ESU 115, you've had an arch formation that tested the 1950 low and is running fairly nicely at this particular point off that low, but it's down 37 points. What does that mean? Well, take away the 120-minute chart for a moment. Let's put it here. Put it in the corner. We'll get back to this in a moment with the other indices. Look at the way you've made the arch formation. And remember, yesterday we were talking about a potential peak A in many of the indices, and in this case it's the futures. And once it pulled back and it came down, and it took out yesterday's, no, it wasn't yesterday, it's the 27th, the low of the 27th at 1934.50, that became a very important factor this morning. So a close in this, I would say in the next hour and a half, on the 120-minute chart above that low of 1934.50 we're exactly there right now, is going to be very important for a number of reasons. Okay. Now what I want to do is to quickly switch over, and I'm going to go to the SPX.X. This is going to be to show you. Here we go. That's the same thing here in the arch formation of the daily. The weekly chart, my rule of thumb is that in this very long wick with a kind of a Chapman wave Roman candle, a pullback to half of the wick, the length of the wick, holding there for a couple of bars in a shorter time frame, that would be a daily one, and that would be underneath 1928, would be very negative and suggest that the candle wick will be completely filled very shortly, going all the way to 1867. So this is a very important moment. And then we've got the Roman candle wick right here. I didn't type it in. I'll type it in right now. This is called Chapman wave. I discussed this yesterday. And the implication is exactly the same on the monthly, that if it starts to trade on a weekly basis, I actually said on a daily basis to subscribers, let alone the week. But if it starts to trade in that 1928 area, 1924 actually for the monthly chart, there's a real good chance that you're going to test, the S&P will test the bottom. So let's just run this now in terms of overall picture, where we are. And I'm going to go to John in Philly for that because he's got a good question, I'm sure. John in Philly, how are you?
Basil, you read my mind. You, frankly, were addressing my very question just in those past 60 seconds regarding long wicks that we see on the monthly and the weekly charts for the Dow, the S&P, and what have you. Can you just share with me, now you've stated your rule of thumb, namely, you decline more than halfway down a big long wick, you tend to go to the bottom. Can you tell me, have you come up with any traders' tactics that you've successfully used in the past, whereby, I'll give you an example. I had shorted the ES futures, the S&P up at 1987 last week.
Wonderful, yes.
And when we came down hard overnight, and as we're coming down, I'm left with that question, okay, fine, when you're going to cover, where are you going to cover? And I'm just wondering, have you developed traders' tactics on where you'd buy or where you'd cover shorts as you come down into wicks like those?
Okay, so this is the rule of thumb. It doesn't matter what, because these are fractals, this is human nature, this is the way markets trade, these are patterns that you'll just see constantly. The Roman candle, the one that I termed a Roman candle, let me just move this away here, is something that I came up with only because almost satirically. What I'm looking at is, in this particular instance, the number of times that I have seen that this particular pattern here, let me go back since we're back to talking about the Roman candle in the monthly chart. The number of times that I've seen this particular candle be filled in, and I'm going to go in this particular instance, you might recall that back in 2007, the Dow had this exact pattern. Where was it? 2000, oops, I went a little too far. 2007, not only was there a doji candle, there it is. Not only was there a doji candle, I need to expand this so that we're talking about something that is visually easy to see. There we go. Not only was there a a doji candle at the top, the Dow went to, in October of 2007 went to 40,198, but it was followed the very next month with a candle that had that big red body to the upside and a wick. I usually do like to see this, the third one, the third bar after that. This bar right here is perfect in terms of the pattern that I usually like to look at, because I like to see a long wick. And the reason why I called it a Roman candle is because when you light a Roman candle, it goes whoosh, and it explodes and it makes this fantastic pattern, and then it just fizzles and it's gone. And that's kind of what happens with a Roman candle. Invariably, unless within one bar, the very next bar, you need to see the price of whatever it is you're looking at close above the wick high. Mm-hmm. And then not only is that just one piece of information, You need to see that happen 2 out of 3 consecutive bars. That would be 2 or 3 months. But usually we're looking at these in a much shorter time frame. That's number one. If it closes above that, that's very positive. First of all, it's very positive on the short term that it closed above the previous month's wick. And then secondly, it should go higher. But the wick, when it occurs near the top of a move, is potent. And I'll talk about, can you hold on? And I'll talk about that when we get back.
Thank you very much.
Okay, and I'll talk about the trading setup. I'll be right back with Don and Philly straight after this break. Basil Chapman, Dow's down 291, it's down 30. Be right back.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Folks, we're back just for traders. The Dow's down minus futures. Dow futures are minus 282. But you see, we've gone to leg C. We're still underneath the most important high bar, which is at 9:48 this morning at 16,247. And the E-minis are at 1936, down 33. Have to tackle the 1938.25 high at 10:38. And then you have to tackle the 948 high, a little higher of 1939.50. So that's going to be very important. Now, I'm going to go to John's question. John had trouble with the phone line, but that's okay. He's still listening through the den. So this is the Dow Diamonds monthly chart. This is a lot better than the Dow itself, which has that alternate count G/C. This went to a D. It's just funny. The SPY and the Dow have given me the exact notation that I want without any questions. This is the candle we're looking at. Well, it turns out back in May of 2011, see that little candle there? Let me see if I can make that a little bit bigger. There you are. There's that Chapman wave Roman candle right there. Big body to the upside, opens and closes in the midway point, and you've got the long wick. Broke down and it went under. And there's the next one. And that candle, the monthly candle, that was the candle of the 31st, that was August of 2011, had a much bigger body and then a much longer wick. And my rule of thumb, and this goes to your point, John, my rule of thumb is that for whatever time frame you're looking at, you need to see the price, that halfway mark. In this particular instance, the halfway mark on the Dow Diamonds would be at about 112. You need to see a close below 112 for maybe 2 out of 3. In this case, it could be weeks, could be days, but you need to hang around there. You can't just have like Monday. You can't just have a spike to the bottom and then spike to the top, and then for the Roman candle, go right back and then close back up again. That doesn't do it. You need to hang around at that level. Why? Because hanging around starts to imply that the MACD and the stochastic of the shorter time frame is starting to weaken. And that's going to say that that weakness will not allow it to rally very much more before more downside testing is concerned. So keep that in mind. That's my thinking. So here we go to where we are currently. And we've only just, this month, August, had one single bar with the most incredible, Larry Pesavento showed earlier on. He showed a chart of the S&P, and he showed that this move is one of the biggest moves we've had in a long time. That is, in 1 month, we've gone from 176.87, this is the Dow Diamonds I'm talking about, but they're the same. The measurement's about the same. So from the 176s down to the 150 level. That is just huge, right? So what we're talking about is that the candle that we formed yesterday, by starting the month off, today is the first day of the month. So starting off the month, gapping down below the closing price of August implies that we're at a really critical level. One of the things I will just quickly add, since you are short, and I believe you are still short, that implies that the position that you have, I would take one part of that position, not the whole thing, but one part of it, and I start to lower that to, in your case, using the SPY SP, using the close at 1969.29, somewhere under that, I would put that as a trading stop on one of my positions. Why? Because the way that the rallies have formed this morning, and even yesterday, where there was a really good rally going to Dow, I think it was maybe minus 20 or something, and then it started to break down. I also have a Chapman wave trend gauge flashing, and that says that at some point off the low, the market should rally. The cash market should be impacted by the futures running sharply off the low. Well, we've already had that. Let me go back to the Dow Diamonds on this chart, and let me go back to this chart and this chart here to say you've already gone from a low of 1914. Let me just double check. That was this morning. 1914 all the way to 1939. So that's a 25-point move. So in fact, that in a sense, that has worked off the low. That's what it says. Within 1 to 2 days, you should have that kind of a rally. And now we're in new territory, and that means that we're failing to make that new high at a peak C. We're going to be watching this very closely. So let me go back to the Chapman Wave Roman candle. And basically, to make it real simple, the month has started off on this candle. At any point in any week, if there are 3 out of 5 days that you see the Dow, that the diamonds are closing, as I said before, so this will be at 159. I'll talk about that. I'll give you the prices when we get back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, we're back. So just quickly to finish up. So the week that we're in right now, if there is in the Dow, if we start, in the Dow Diamonds, which is trading at 162.23, if there are maybe another couple of days where the Dow Diamonds start to weaken and they close over the next into Friday at any point for 2 consecutive days, or maybe 2 out of 3 consecutive days, close under 161, that would imply that there's a really good chance that in the monthly candle, September is going to see a move down without much more of a bounce at all, other than just little brief bounces, and we will be going down to the lows. That's kind of the way I would look at it, and this is not really a Roman candle in the Dow Weekly. It's just the body is way too thick, and it stopped right at the 200-period moving average of 155. And the way I'm looking at it right now, this has been going on for a few months now, this down move. So I can understand. The reason why I was expecting a bit more of a rally was only because we came down so sharply. We had the 1,000-point reversal that the technicals of the 120-minute were looking outstanding, but it did suddenly go to peak in the Dow Diamonds and then pull back sharply. So I have to respect that, and I have to also respect the tide. I always talk about the tide. If the tide is going out, any piece of driftwood that you throw in the water is not going to come to shore. It's always going to be pushed out. That's the way I have to think of the larger context. Let's go to Victor in New Jersey. Victor, how are you?
Hey, I'm good. I have 4 things I just want to go over. You have gaps on the SPY from December 2011, and I think that's where we're going to go. And you have a gap on 2012. You have a gap from 117 to 118.84 that hasn't been filled. You have a gap on December 12th to 2013 from 138 and 135. There's a gap there. So you're going to go back to 2011 if the gaps are getting filled. And you also have a gap on Apple at 73. And tell me what you think of your FCX and the fear factor. And also, we're going into September. There's a thing called the Shemaya. It's a Jewish thing where every 7 years they cleanse out the system, the whole financial system.
That's right.
And this is the year that it's going to be happening.
Well, I can't do it right now. And let me just see.
Well, what do you think of the gaps on SPY? They got to get filled.
Okay, I'm just showing this chart for those of you. For those of you in the den, I haven't been able to update this lately, but this discusses the 7-year. The 7-year. I discovered this way back in early 90s.
Pretty
I think it
accurate.
was. So the 7-year rallies. It's approximately 7. Sometimes it was exactly 7. Sometimes a little bit early. So I just wanted to say that let me just finish this so that I just wanted to say that the move that we're in now coincides with 214, 215 as the potential for a sharp reversal. 2016 is what I would call the codeth. There's going to be a decent base formed and then another big move after the very sharp decline. Then that's what I'd be looking at. So I'll deal with that maybe later in the week. So I just wanted to get very good point about the 7 years. Now let me get to I'll do them one at a time. So FCX, we actually took profits there. I hate to say it, there was about a 40% gain on the day that we actually bought the darn thing.
That's from George Soros, right?
That's right. No, that was Icon. And Icon said, someone said he was interested, and it spiked up. We were in at 823, and it went overnight. It went to 14 something. Anyway, 12 something. However, we did get out today because we were stopped out for a 20% gain. I will be looking at FCX Freeport McMoran again later. I just need to see because high-grade copper is really acting. It had a great move, and now it's going to be very important. Do the commodities hold their recent gain, that is the gain of the last few days, or do they not? So let me just say, I'll give you exact numbers for FCX trading at 9.90, down 74 cents right now. If it takes out if it closes under 9.40, then I think we have to reestablish a whole new buy signal, both in the daily and in the weekly charts. And I'd be stepping aside. If it holds here and by, what's the name? Today is Tuesday. By Thursday afternoon, it's in the 1060s. I'll say, hey, that's not bad action at all. I'll reconsider it. So at this particular point, we're out. I have to step back and I have to say, what is the support? If there is support, maybe it's worthwhile going back in. And if it manages to rally, I'll have to say, okay, we've missed our best re-entry. I'll have to see where the next re-entry is. I'm out at this particular time. Your question about the VIX index, this is going to be very interesting. The VIX is only up 2.26, up 7.9%, with a 300, 400-point move in the Dow to the downside. This should have been screaming. However, the TVIX is in leg D with a little doji candle forming. And I'm looking at this very closely to see whether or not, so that's C, GSAS-C in the 120-minute chart. I'm looking to see whether or not there is a close towards the low of the day as the market tries to rally later on. And if it closes under about 1630, it's at 1746. This is the TVIX, 200% long, the volatility index. But leg D, I've got to respect, but a huge leg A, and that could turn into a single leg A up if there's a sudden turnaround in the market. So let me make it clear. The volatility holds, the volatility index, the VIX index, closing today anywhere above 30, especially if it gets to 3150 or higher, says be careful. There's even more selling coming in overnight and into tomorrow morning. That's the way I'd look at it. And if it's suddenly at 30.83, if the VIX index, the volatility index, closes the day underneath 29 as the market manages some kind of a rally, 150-point rally from where we are, then I would have to say, all right, that could be it for now. You have to wait. Maybe there'll be interim days of up, down, and then I'm going to have to be watching the levels that we are concerned. I think I've covered most of your questions, right?
But, the gaps, I think those gaps are going to get filled. You're going to have a crash by October, November. And if you go with the WD GAN angles and all that stuff, our angles are way too, they're not on the, they're more like, your Eiffel Tower effect. I think you're setting up for a crash in October, November. And it's going to be quick and smooth.
Let me just talk to that issue, because I had an email from someone I know very well via email, and I know him from some years ago. And he had done a lot of work talking about a crash. And I said to him, I don't see a crash in the chart formations right now, because we've already had a big rotation throughout the year. And if you look at the GEs, GE...
It's all on quantitative easing. The quantitative easing is so that the derivatives the banks are holding, the banks will be... Otherwise, the banks would not be solvent right now if you didn't give out the quantitative easing to the banks, because the banks are insolvent.
I cannot disagree. I think you've got a great point there. But what I'm saying, just chart patterns per se, the 1987 crash formation, the 1929 crash formation, we've changed that format. We've got rather a very large arch formation, and you've already seen an IBM go from 215 to 143. You've seen a triple M go from its all-time high of 170.50 to 140. You've seen UTX. So I think a chunk of their consolidation has already been done, but that doesn't mean to say that they can't come down further. What I am saying is that the actual pattern of a crash seems to me to be different. That's not to say you couldn't get the same result by just going down every month for the next 3 months. Very seriously. There's a big difference.
How are you going to get the gap on SPY still to 135? That's going to be a crash. I've done quite
a lot of work on this, and the way I'm looking at the SPY 181.92, the low of October, hasn't been taken out. It's how we take it out. And if we do take it out very sharply, then my thinking here is that the 165 to 160 area will probably be the most important containment area for the SPY.
It's 911 upside down. It's 119.15. You're going back to December 2011. 611 is 911 backwards. Just remember December 2011. Okay. Everything's symbolic with the people, the big people, the Bushes, and all those people. Everything's symbolic.
I know I've read about that, but I'm also looking at the chart formation, and I think that
it's an election year. You remember when they had the election year when Obama was going in? They crashed the market that year.
Absolutely, but there were other reasons, and we'll see whether the reasons repeat over again. But you know what? I'm keeping it in mind, and I had a call from I can't remember from the Midwest. I can't remember his name right now. Talking about the expanding wedge. That formation is also viable And that says we could go down much further. But Victor, I'm going to be looking at this very closely, believe me. So thank you very much for your comments and your call. That's Victor in New Jersey. Well, I cannot ignore it. I mean, he's got some very good points there. Let's go to Jerry in Boston. Jerry, how are you?
Good. How are you?
I'm well, thank you.
I'm interested in Foot Locker.
So Foot Locker trading right now at 70.52. You know, I didn't do any work on Foot Locker. The name came up recently, and I said, you know, I used to do work on this, and I didn't. You know, I remember the stock. I'm going to see if I can squeeze it here. Maybe they had a name change or somewhere, a symbol change. No, I remember this from way back in the 1980s, and then again in the late 1990s. There was someone I knew from Chicago who used to trade this thing like mad, and he'd pick it up in pennies, and he'd make a bundle, and then it would come back again. So Foot Locker is gone basically from the 2008 low of 365 to last month's high.
I bought this at 33 about a couple years ago.
Yep.
And now I'm getting nervous about the market. The fundamentals are unbelievable, but I'm thinking that we could have a psychological shakeout, sort of an 87 type thing on. I mean, the banks are in the best shape they've been in years,
right?
Decades. But I think the confidence is fragile, and we can have one of those big declines out of confusion through so many things going on around the world. And so I think that this thing is owned by the what is that group? The IBD group. And so I think it could have a big shakeout. I mean the players. You know, it's one of those top 20.
Yeah, right.
So I'm thinking, I'm thinking
Jerry,
of selling it on the possibility of a big break in the market temporarily.
Okay, so let me do this. Foot Locker FL trading at 70.58, only down 21 cents, down 0.30. And I had looked at a number of the areas in the clothing. I think it's PVH. Was it PVH? Some of them have held unbelievably well. And what I'd say to subscribers this morning is I think now we're starting to see the restaurant group highly vulnerable, and I believe that the auto parts groups are now becoming somewhat vulnerable, not highly vulnerable yet, but somewhat vulnerable. And I looked at the clothing area
in that group.
But Foot Locker, whenever I go past Foot Locker, there are always people there. I never find anything for myself, just personally. And I'm always amazed at what they've got. And then I look for just a pair of plain white tennis sneakers. No, I don't actually like the tennis. I like them as running shoes, but white. You know what? It's like when you go to the supermarket, there is nothing plain anymore. Everything's flavored. I can't find them. So I think that there's been a dramatic change. And I keep looking and I say, how can all these companies who can't produce one thing anymore, it has to be one thing that has derivatives in color or shape, but it cannot be just plain vanilla anymore. It has to be, how do they make out? What happens at the end of the inventory season? What do they do with all the leftovers? I just don't understand what happens to the waste. Maybe they have a way of doing it, but Foot Locker seems to have managed it. It's managed it very well. Now, let me explain to you just on a purely technical basis. Foot Locker made a peak F top on at 74.95 by 5 cents and missed a round number high back in the week of August the 21st. It had a sharp pullback with last Monday's crash and reversal to 64.03. Not a big deal in relation to where it's come from, but it set up a weekly chart, a monthly chart that says that the long-legged doji is telling me that it has tremendous resistance going into the 72 to 74 area, 75 area, and it has support that must not break in the 64 area. And the low, in fact, was 64.03. So for me, it's well defined if you are a long-term investor. If it starts to close any month, and you can even see it intra-week, but I prefer to use it as a monthly candle. If there is a close under 63.50, I would start to lighten up my position. You don't have to get out because it's had spectacular upside reversals before. But the MACD and stochastic are right on the cusp of being vulnerable to a turn down, but they haven't turned down yet, number one. But the weekly chart, that's the shorter term, is turning down. It hasn't crossed negative. It hasn't closed underneath the 9 EMA of 69.80. So this is my recommendation to you. This market is going to test the very best. It's going to test the very worst. The very best are going to be tested, and it also had a silent doji on the 19th of August at 74.49. The previous day was 74.95, the all-time high. So I'm looking at this, and I'm suggesting to you, on some part of my position, I would have, at least I'd take a little bit off. You could do it now, but definitely at 68.50, I would take a little bit off. I would hold the rest. And I'd hold the rest because fund managers will still come back to the best of the. Actually, you want to hold on? I want to do a little work on this. And can you hold on?
Okay, sure.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of The Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, everyone. We're back. Basil Chapman, Tiger Technicians Hour. Dow's down 309. S&P is down 36. So we are on with Jerry in the Back Bay, Boston, and we're looking at FL, which is Foot Locker, and it's been one of those outstanding stocks that has just been imperturbable. It just did not care about market conditions because they have a good business. Obviously, they're doing the right thing. My biggest concern is that in the Chapman wave, we've got a peak F in the daily. I didn't have a chance to do the monthly because I want to do more than the 120-minute chart, which is pulled back sharply from a peak D. And you've got a D in the daily that made an all-time high on the 18th. So my suggestion, the way I figured this out is that in the patterns that we're looking at, because there's a rectangle formation that says that there could be a containment area, if Foot Locker is able to avert any sell-off and not go even close to on last week's Monday low of 64.03, I'm not sure it's going to be able to, but you never know because fund managers are looking for stocks that have held up and they're going to be buying it. So for the next 2 days, if Foot Locker doesn't close under 68.50, it's at 70.56 right now. That would say to me, and the reason why I normally would say to you, take something off right now and you could put it back later on. I would rather say to you, do it and keep a core position, but in 2 stages. One is either you can think about it. You don't have to rush into it, but roundabout here at 70.54, 2 points off a few points off the all-time high, 4 points off the all-time high. It's not a bad idea to take something off in terms of money management. Or you could just say, hey, let it do what it's going to do. But if it closes underneath the candle of the 26, that is underneath 68.61, I'm then going to take something off because then it should revisit the low 64s at some point, and that would at least, that's good money management. So either way, I'd be looking to take something off if conditions are met over this week, over the next few days. The other thing is, in the core position, you might find that it drifts sideways and it tries to rally and it doesn't go anywhere, but in fact it holds within a 3.5% to 4.5% range under all market conditions. I don't think it can do that, but if it does that, that's just saying this is a very strong stock, and anytime the market has a rally, it should be a participant to the upside. But in your core position, closing under 64, I'd start to look at that and say, you know what? Maybe it is time to start lightening up. So I would not do anything just yet. Maybe Friday or Monday you can give me a call and we can look at it again. But congratulations on holding this. Congratulations on identifying it. And I think you've done very well. I don't think there's going to be all that more to the upside, but it could hold quite well, which is really a good.
Thanks a lot. You give me a really good picture of all the variables. And
okay.
Thanks a lot. Have a good weekend. Take care.
You too. Thank you very much for calling, Jerry. So let me do this, folks, as we're about to go. And then, of course, you've got Kevin coming up. Should be a great option show as always. Listen, the VIX index is at 30.75. It should be much higher. The day is young. It certainly could. I can assure you, if the market goes down another 65, 75 points, the Dow and the S&P another 10 points, that volatility index will really, it should spike into the 34, 35 area. If instead buyers come in and they try to support the market, even they don't have to do much, they have to go up 120 points, shouldn't be a big deal in this environment, 120 points, but if the Dow can do that, watch the VIX index, because the fact that it was holding high, the fact it was holding in the 25 to 27 area said, don't ignore the fact that fund managers are finally recognizing they've got to buy insurance, and that's what they're buying. The fact that it's holding high says that their belief that the market will come down is starting to increase because of the insurance they buy. So those are the parameters to watch. Dow underneath 16,000, very negative. Dow trying to rally and closing in the 16,280 to 16,330. Phew, survived another day. So thanks for being here. I'll be on a little later on with Tom O'Brien. Otherwise, I'll see you tomorrow. Have a great day.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,